Well, things are looking a little better this week. We've got the markets coming back up to their moving averages. Will they stay there and move forward, or is this just temporary? Let's find out. Joining us on the program is Mish Snyder from Market Gauge. Mish, let's talk about some of this stuff. We had the Fed meet this week, and a little inferences like maybe we won't be heading towards 2% inflation, and maybe there's a possibility of a rate cut. So we've gone from six cuts at the beginning of the year, three to maybe one.
I have a couple of conclusions from what happened in this last Wednesday, which is exactly what we kind of anticipated happening. And that is number one, that he said, obviously, that he wasn't going to raise, that his next move could be to lower interest rates. Two is he said that obviously he would be somewhat data dependent. So, of course, the unemployment numbers were perceived as soft. It's still a pretty robust labor market in the U.S., but still softer than what it's been. And they had an objective of a 4% unemployment rate that they would get to before they started cutting, and it was 3.9% today. And then you add on top of that, he did make some level of an intimation that 2% as an inflation goal may not be realistic, although he was very coy about it. And, finally, the most important thing is that coming into this week, I was following the will they or won't they Bank of Japan intervene on the falling out of bed Japanese yen. And one of the things that I read that was so interesting to me by another analyst was that they were waiting for our Fed meeting before they made any real intervention. Even though we saw the dollar yen get to 160, it's really come off since then. The yen has come up, and partly because of what Powell said. So it was smart. So essentially, the other piece of research that I kind of dusted off my old books on from 2008, 2009 was the notion of Operation Twist, because Powell also said that they were going to start to slow the taper of QT. And what he could be really saying is suggesting that perhaps they start to lower the rate on the back end on the long bonds. And so what they basically do is buy the long bonds and sell the short bonds. And so in essence, what they do is they flatten the yield curve. And that's a good way to deal with things during potential recessionary times without actually having to lower the interest rate. So all of this looks like it's possible right now, but the question is, does it matter? Is it intervention at this point, one way or another, going to stop the train that we also saw this week, right? Which is what you and I have been talking about for years, and that's stagflation.
Yeah, I mean, we got a 1.6% print for first quarter GDP. The inflation numbers are going higher. And more importantly, we've got three consecutive months now that we've seen rising inflation. And then I take a look at Mish at the amount of money that they're spending, whether it's going to be $100 billion for a Ukraine bill, a 1.2 trillion supplemental bill. That is pushing a lot of money into the economy, which is almost like the opposite of what the Fed wants to see. They're trying to control inflation, and fiscal policy is pushing inflation.
Absolutely. And, I always believe that all governments, as much as they like to say, and when I say all governments, whatever party's in charge at the time, spends money and pushes money into the economy. It's just what they choose to do it on. And clearly this administration, it's been sort of across the board. I mean, they're also continuing to do forgiveness of student debt as part of that. And on and on and on, the CHIP Acts, with the money that was put into infrastructure, et cetera. And yes, all of this has been inflationary, but also if we had to take the other side of the argument, we could say it's also avoided any kind of real economic disaster in essence, and it has been somewhat of a job creator. But the problem is that's just one component, right? So you've got a high interest rate on our ridiculous debt at like 34 trillion. Then you have the geopolitical situation that's coming into it, which of course has forced more government spending. But on the other hand, it hasn't really done very much in terms of stopping the war in Russia-Ukraine. I mean, that's still going on. And we don't really know what's going to happen in the Middle East because It doesn't seem like that's slowing down either. And there's just these sort of pockets of threats coming from Iran after the last couple of weeks ago, still out there. So you put this all together and it's all the walls that we've always been worried about, which is there's a fracture underneath the surface. And if that fracture widens and the dollar falls, which again, going back to the yen intervention or potential intervention or the rates not going up anymore, we can still get into that super cycle of commodities, even though people have dismissed it because they look so myopically at one thing. Well, oil's not really going up, so we're going into disinflation. Well, maybe not.
The thing that really strikes me, AI was the hot topic last year, still this year a little bit, although I'm seeing some of these stocks falter. The thing that really struck me that nobody's talking about is electricity. I mean, I heard like by 2028, AI alone will take 25% of our electricity. Add to that the cloud, another 10%. Mish, where's that electricity going to come from? How's it going to be powered? Is it just, I don't think it's going to be a windmill.
No, no. Well, there is wind energy, but it hasn't really, I think, taken hold in this country very well. But that's a great question because it's also something else we're starting to see in the market. So you're absolutely right. The expansion of AI and how these supercomputers work is they require a lot of raw material, water being one of them, by the way. And water, if you look at the ETF PHO, has really rallied this year a lot. I mean, it has its corrections, but the trend's been up. And I just wrote a whole article about natural gas, because it turns out that natural gas is used in AI. And even though a lot of these companies keep saying they're going to reduce their carbon footprint and go more to solar energy, that's so expensive right now that natural gas, which is completely cheap, I wrote an article about last night. My timing was actually really amazing, spot on, because today we're starting to see a big rally out of the basing pattern we've seen in the natural gas futures. So that's number one impact of the AI. The second, and you mentioned electricity, is the utility companies are starting to do very well as the ETF XLU, which generally doesn't do well unless we're going into more recessionary times because it's interest rate sensitive, but it's doing well regardless because it is the delivery system for these raw materials for electricity and water, et cetera. So yeah, there's two impacts that I don't think anybody really counted on. And that's why I'm just having a blast trading different commodities this year.
Well, this is one thing that I don't think a lot of people are paying attention. I know in our business, RIAs, how many RIAs I think own gold? It's probably less than 1%. And here we've got gold. It got up to about 2,500 briefly. It's right around 2,300 right now.
Right.
And so speaking of gold, let's talk about that because it is underowned, unloved. And I just take a look at the macro environment and I go, I got to own gold.
Well, yeah, that's another thing you and I have talked about in the past is, we do own gold and we have owned gold since basically $1,500 an ounce. We're more actively trading it, but we have a core position. We also own silver and we also own gold miners now. And both of those have been kind of slow to really move, and although silver is holding around $26. But yeah, I mean, you're absolutely right. Gold has been unloved. In fact, this week, all the bears came out in gold again because people think a correction is the end of the market. It may have been the case in cocoa futures. Yeah, that was definitely the end of the market when it turned over. But it's very different with gold. And there's also been the gold Bitcoin conversation. And while Bitcoin has, over the longer term, outperformed gold. In the last few months, gold has been outperforming Bitcoin because Bitcoin turns out to be also interest rate sensitive and not so much a flight to safety yet. So in terms of the underinvestment of gold, we know that banks around the world have been buying gold, China probably being the number one buyer of gold. I think India is way up there as well. And yet the United States started to buy some gold on that one little rally after October 7th with the Middle East. But yeah, I think most investors right now do not have a lot of gold in their portfolio. And those that might have gotten in over the last couple of weeks looked like they just got out because they saw it wasn't going to go any higher. I still think gold can go 2,700, 2,800, maybe even 3,000. And I don't think it has to happen anytime soon. I'm patient. I think that it can happen because I think things are getting more chaotic. There's these fractures, as we just said. And I think after that, though, after we see that happen and maybe silver get back up to 40 or even 50 in that kind of rush of madness to get into something safe and as a hedge for inflation, then I think that might be the final hurrah for the metals. And then by 2026 or so, we can start really looking at maybe Bitcoin being the thing that people run to.
I want to talk about something else here related to the economy. And you and I were briefly talking about this before we went on the air, and that is transports.
Right.
You know, the Dow theory, they have to confirm each other. I'm looking at the transports, and that isn't a pretty picture.
Yeah, good old Charles Dow, right? It's amazing because we've come so far from when he came up with the whole idea of the transport index and the Dow Jones Industrial Average. And a lot of people don't realize that that was actually named after Charles Dow. When I say people, I mean people under the age maybe of 45. And yet, really what it represents is such a huge part of the economy. In my economic modern family that I created, transportation is definitely one of the key sectors with small caps and with retail. Druckenmiller called those three things the inside sectors of the U.S. economy. So we can't emphasize the importance if goods and services aren't moving through, the old movie planes, trains, and automobiles. What's going on? So this is the stagflation part right here that we're potentially seeing. So what happened last week, coming into this week, is the market rallied and then transportation fell. As we came into this week, transportation continued to fall, and now in the last couple of days, it's found some footing. So if you look at IYT, that's the one that I really have always used for consistency purposes, and you look at the weekly chart, yes, it held a major weekly moving average, and that was at around 63.30, where it was basically the low this week, and now it's up over 66. But if it can clear back over 67 and starts to roll over again, I think it would be really hard to make a bull case for the S&P going to new all-time highs. And instead, I wouldn't say necessarily sell in May, but we could say chop in May. And that's certainly what we've been seeing over the last 6 weeks.
Let's talk about some of the stuff that we're seeing. We've got conflicts going on overseas. We've got conflicts all around the country on college campuses. You almost see it daily. It's got here to California at UCLA. Mish, it reminds me to some degree like the 60s and to the 80s. We had conflict, we had oil prices, we had college protests over the Vietnam War, and they're protesting on what's going on in the Middle East. A lot of similarities.
Well, the old expression that history doesn't repeat, but it rhymes. So I think maybe a couple of conversations ago, I had sent you that overlay chart of CPI from the 70s to now since 2020. And it almost followed it exactly to the letter, where when we saw the peak in CPI in like the sort of mid 70s, and then it troughed down all the way. We saw the peak in CPI in 2022. And then of course we had the big trough. And then it was in 1978 that CPI started creeping up. And then of course, 79, 80, it went crazy until the Volcker thing. And now we've seen a slow ascension, as you mentioned earlier, of CPI creeping up. So if we look at the similarities of what you're talking about from an internal unrest, social unrest, this is part of the chaos that I've been thinking about, and it just keeps manifesting into different things. So right now, of course, it's the college protests, and it's going to be a very interesting election year too. So I do see the similarities. Generationally, you always are going to get to a point where the younger generations want to question the status quo. Sometimes you have permanent changes, like the generation of the 60s and 70s had some permanent changes to it, but really not. I mean, if you think, so I think that the same thing here is that this is not necessarily going to be a game changer for how the U.S. operates, but what it certainly says is that people are just angry. And whether they're angry at things costing more, or they're angry because they can't afford housing, or they're angry because they don't believe in the government, or whatever it is, or manipulation, or just the politics that have become so ugly with this current election coming up between Biden and Trump. This could add fuel to the fire. I just don't know if it's necessarily going to be a long-term effect, but certainly I think we're going to see some issues, like I said, with gold being the barometer up until maybe end of 2025 into 2026.
And how much of this anger strikes me is due to inflation. Last night, a group of us got together. California raised the minimum wage for fast food workers to $20. So we decided we were going to go out and have a hamburger and fries. What does this really cost? Well, I didn't want to eat junk food, so we went to Five Guys. Mish, I had a double meat patty, a cheeseburger, and French fries. The two burgers were $29 and the French fries were $40.
Oh, ouch.
I mean, yeah, I know.
Well, I'm vegan, so, but nobody else in my family is. So I kind of get it from all ends, because it's not like, yes, inflation is definitely an issue. And if you want to try to not eat junk food, and you're going to go to a regular restaurant and get a hamburger, you're going to pay 20 some odd dollars for that hamburger. And even if you're going to go for a veggie burger, once you say you're vegan, they charge much more money too. So what the younger generations are seeing is that no matter what they want to reach for, the costs have gotten out of control. And yeah, that's definitely, this is always what makes people angry. Do you remember that conversation we've had about sugar and how sugar?
Oh, yeah.
Yeah. Okay. So sugar has come down from 28 cents a pound to about 19, 20 cents a pound, which has been interesting because cocoa skyrocketed, coffee skyrocketed if we're looking at soft commodities, and sugar actually went the other way. But in the 60s, let's go back to the 60s and into the 70s, when people are feeling stressed out about eating, they turn to junk food and comfort food, and that's sugar. And so there's a little insidiousness going on with some of the other things, like olive oil, new all-time highs, butter starting to creep up again. And now I'm watching this sugar because it seems like it might be basing. So if you really want to see where inflation can go nuts, keep those eyes still on sugar, because what it represents is public dissatisfaction. And at that point, almost like a resignation that they're just going to eat whatever is the least expensive, which usually has sugar in it, and wait for the tide to turn. So sugar hasn't happened yet, but I'm watching. I'm watching to see if it gets back over 20 cents.
And here locally, we're watching real estate and rent. A average, I'd say 2,000 plus square foot house is anywhere from 1.1 to 1.3. I don't know how anybody can afford that with a 7.5% mortgages, and rents are anywhere from 2,800 to 3,000. So you got to think of these young people. It's expensive to go out to eat. It's expensive to go out on a bar on Friday night. I was talking to some of my employees, $8 for a beer. And, and then you take a look at rent. Everywhere they look, it's like it's unaffordable.
Yeah, and so who do you get angry at? Who did we get angry at in our generation that you just mentioned? As much as I always hate to admit that I'm part of that generation, we got angry at the government. And that's exactly, right now, the anger is more geared towards not just the American government in support of Israel, but the Israeli government. And we're not going to even touch that subject. But the point is, it's governmental anger. Unfortunately, what happens often is that individuals get swept up into that because when people are angry, they're not necessarily discerning one thing from another. And housing is certainly another reason to be angry as these interest rates have come up. Houses are unaffordable, yet, and housing pricing has not really come down. And definitely shelter costs, especially as you're looking at rents going up. This is something actually Janet Yellen even mentioned as one of her worries this week. So Yeah, I mean, if you're a kid coming out of college and you go, damn, I'm going to have to live with 5 other kids or go home to mom and dad, and I'll never be able to afford to buy a house, or at least not for a very, very long time. You know, the generational divide between the wealth of the baby boomers versus the younger generations, we are the first generation that is leaving a legacy where our younger generations are worse off than us financially than we were when we inherited it from our parents.
So given this macro environment, we're in this age of volatility. And one of the things I'd like to get your comment of how quickly fund flows shift from one sector to another. You think, okay, gold was starting to go up, so everybody started to notice it, and then it corrects. Medical stocks were going up, then they correct. So we're seeing this transformation, or you see people going in a sector and it doesn't stay there. It hits a peak and then boom, onto something new.
That is absolutely right on, because the retail space since COVID has become much more active in their trading because people realize the buy and hold is kind of old fashioned. And so I like that personally, because it tells me that you can get these opportunities, get out and look for the next opportunity, which is exactly where I cut my teeth on the floor. If gold was moving, you traded gold. If that stopped moving, you went to oil. If that stopped moving, you went to sugar, and so on. And so that volatility, in essence, is the direct result of the retail space trying to follow the money. And the other offshoot of that is that you just mentioned, the narrative changes according to the price. That is something that people think is unique. But as a commodities trader, we all know that price actually changes the narrative. And so that's exactly what we're seeing right now. Price changes the narrative. Everybody was all about gold a couple of weeks ago. Now everybody coming into this week is back into, Apple and AI, but meanwhile, Apple basically bought back, $130 billion of their own stock, which is staggering. And the next week, it could be something completely different. But this is for an active trader. If you know what you're doing and you understand risk parameters and profit targets, you're having a good time.
All right. Well, on that, if our listeners would like to follow you, you've put out a lot of stuff on your website. Tell our listeners about it.
Well, I write a blog called Mish's Daily, or Mish's Market Minute Daily, however you want to see it. It's on our website, marketgauge.com. Many other companies actually reproduce it for their sites, like See It Market, for example. And so you can find it on Twitter, X, which my handle is @MarketMinute. I have a book, Plant Your Money Tree. I actually have also been rereading it myself, because it's really showing how to follow the weekly charts and the weekly phases so you don't get caught up in all the chop on a much shorter time frame. And and I get to talk to people like you, brilliant people, and do a lot of media. So you can find that also on the website, my media clips, or our YouTube channel, which is Market Gauge.
So the traditional saying, sell in May, go away, come back after Labor Day, it's looking more like chop.
Chop in May and don't go away, because we're going to have a very interesting summer. We didn't even talk about weather, but that's a whole other thing. As we get into summer, hurricane season, power grids failing, another case for natural gas potentially, as Texas is expected to heat up a lot this summer. So yeah, don't go away. Just make sure you know what you're doing. That's all.
Okay, well, maybe we'll pick up weather next time. All the best.
Thank you so much, Jim. All the best to you as well.